Oh, okay, all right. Thanks for Ilya for the introduction. So I'll be expanding on the co-integration part, and so first I'm gonna introduce myself a little bit. So I'm currently a PhD candidate in health informatics at the University of Minnesota. Most of my PhD research is on NLP on Twitter data, but however, I'm more interested in in the market. So I chose to join Hudson and Thames apprenticeship program in order to pursue my career path of a quant. And here's my Twitter. I'm kind of like more active on Twitter. And if you have any questions, I don't mind if you send me an email. All right. All right, so there are three key takeaways of today's presentation. So after my presentation today, you should be able to understand the definition and the properties of cointegration. And I will also show you how to simulate co-integrated time series with ArbitrageLab. And also I will show you the minimum profit optimization strategy on a mean reversion trading on co-integrated asset pairs. All right. First thing first, let's start with what is co-integration and why is it important for pairs trading. So assuming if you don't know anything about pairs trading and you just decided to Google, and usually this is like Investopedia, and that's where you find related concepts. And here, usually people will say pairs trading is a trading strategy that involves matching a long position with a short position. I mean, the emphasis here, they always say is high correlation. So the first question that's quite natural is like correlation of what? Let's say we have two assets that has perfectly correlated returns, but you can see they might have divergent spread. Or we want to have two assets that have relatively close movement. So you can see their spread is more stationary, but sometimes you can see the correlation of the returns of the assets are negative. So it seems this is not a very good definition for pairs trading. So of course, why do we say we only can calculate correlation between returns? This is because the asset prices are often non-stationary. And if you calculate correlation between non-stationary time series, you will always get spurious conclusions. Maybe the positive correlation is not real at all. So you want to calculate correlation on stationary time series, and usually the returns of financial assets can be assumed as stationary. It's a very safe assumption. So when we're trading, we cannot really trade returns. So can we find a relationship that describe a possible tradable relationship between asset prices? And here is where co-integration jumps in. So before we actually give the formal definition of co-integration, I would like to introduce the concept of ID series. So ID series means integrated series of order D. I mean, a rigorous mathematical definition of ID series is not actually straightforward. And I think this is a topic that might deserve a dedicated talk. So I will not dive into this, but instead I will give you like a few examples. So for I1 series, usually this is the price. You can either like have stock price, you can have like bond yield, you can have like currency exchange rate. All of these are like I1 series. For I0 series, usually this is like the return of the assets. So you can probably already see that usually we derive returns by either, especially for log prices, we just subtract, do the difference between the log price and we got log returns. So this is like a very nice property for ID series. So I0 series can be obtained by differencing I1 series. So what does this mean? First, we want to know what is so nice about I0 series. So for most financial applications, I0 series is weak sense stationary. So what does this mean? This means the mean function is finite and time invariant. And this is actually the most important property of I0 series. And besides, the I0 series have a finite and time invariant variance. And also the covariance function depends only on time lag. As I mentioned, the time invariant mean property of I0 series is the most important because we can design a mean reversion training strategy on such series. For example, here we have a series with a which is I0 and has a 0 mean. You can see the spread is nicely oscillating around its mean. So now we can give the formal definition of cointegration. So if two asset prices or two time series, XT and YT, are cointegrated, this means XT and YT are I1 series. And there exists a coefficient beta such that the linear combination between XT and YT is an I0 series. So let's visualize this definition a little bit. For example, let's say we have two I1 series. For example, this is like two stock prices. And by combining them with a coefficient beta, here we notice the sign. We want to have the negative beta, assuming beta is positive. All right, so the result is an I0 series, which is mean reverting or stationary. Let's put the two I1 series together, and you can see already in this plot, the two stock prices are moving nicely together. And by combining them with the beta, with the coefficient, you can get the nice stationary series. So what does this say about cointegrated asset pairs? So the prices of cointegrated assets are tethered due to the stationarity of their spread. So if their spread is kind of like oscillating around the mean, that means the spread between the prices cannot go too far away from each other. So from this, we can further imply that cointegration is a measure of similarity of assets in terms of risk exposure profiles. So this gives you some hints on where to look for cointegrated assets. So for example, you can look at stocks under like different under the same sectors, or you can look at like similar commodities, for example, like WTI versus crude, WTI versus Brent, or like some similar currencies, for example, Australian dollars and New Zealand dollars, or you can trade even like the different components on the same yield curve. I mean, these are all possibilities. On the other hand, since we have mentioned the I0 series have the most important property, that is like it has a mean, it has a time invariant mean. So this means the mean might not change for quite a while. So cointegration actually describes a long-term relationship between asset prices. On the other hand, correlation is a short-term relationship between returns. As you can see from my previous plots, I only plotted the rolling 20-day correlation. So this is only used to describe a very short-term relationship between returns. And another extra point for cointegration is from correlation, we cannot know how much long lag to trade versus how, I mean, the amount of long lag versus the amount of short lag. How can we like adjust the ratio between these two assets so we can get a nice spread we can trade on? However, cointegration can give you this spread or the ratio exactly. And since we have like two I1 series to form an I0 series, this beta is unique. So it cannot be like any value. It has to be a specific value. So this gives you the guide how to trade, how to actually design this long-short trade. And usually to get this ratio, usually we call this hedge ratio or cointegration coefficient, this beta. So you can use angle grandeur test. So this is more suitable for a pair of assets because you want to perform a linear regression on asset prices and test if the residual is stationary. However, this method has a drawback. So because you want to perform a linear regression, which asset to choose as the dependent variable, you can have two options. If you have more than two assets, then you have like multiple options, and this might be confusing, like which one to use. And a better method to derive this co-integration coefficient beta is to use a Johansson test. So for Johansson test, it uses a vector error correction model. And this is the preferred method to test for co-integration and derive beta. For further details, I will refer you guys to the references to see how exactly to mathematically derive, for example, the coefficient as well as the test statistics. And in ArbitrageLab, we have both tests implemented, so you can easily just use either one of them. All right, so now we have learned about something about the co-integration. For now, I would like to introduce how to simulate co-integrated pairs. So when you do not have enough data, but you still want to test the properties of co-integration, the best way to start is simulation. So simulation is useful because firstly, you might not know where to find the co-integrated asset pair. For example, S&P 500 has 505 constituents. If you want to explore every pair of them, this is like a very huge number to consider, and this is not very feasible. Also, simulation is pervasive in trading strategy development. When you do not have like real financial data, you usually start with simulation. This is like useful in option pricing and also like Monte Carlo backtesting, and co-integration is no exception. So how to go with simulation of co-integrated assets or pairs? So there's one nice thing about the I0 series. So if a time series is stationary, then it must be an I0 series. So this means we can use whatever stationary time series we want. And usually the simplest one is a stationary AR1 process. And here is the usually the definition of the stationary AR1 process. We want the AR1 coefficient, its absolute value to be less than 1. All right, so we need to simulate two components that are I0 series. So firstly, we want to simulate the returns of one asset, which we have already discussed before is an I0 series. And the other one is the spread actually between the co-integrated pairs. Both of these are I0 series. So naturally we can obtain the following algorithm. So first we simulate the log price. Actually, this is like we simulate the log returns of asset Y's such that the log returns is a stationary AR1 process. And then we sum up these log returns and obtain the log price of assets, the one asset. Here we denote this asset as asset Y. And then we simulate the co-integrated spread between the two assets. And then we can just use the co-integration relationship to retrieve the log price of another asset. So now we have two time series of the log prices. So the choice of using log price here is preferable because its difference has a straightforward meaning, which is the log return. However, according to the Alexander paper, it is also acceptable to use raw price to do the simulation. So here I will show you an example using ArbitrageLab to do the simulation. Here, we used raw price as our simulation. So we can simulate co-integrated pairs in one batch. So here we can simulate 20 co-integrated asset pairs, and each co-integrated series will have 250 time points. As you can see, the parameters here and the result. So here I have plotted like one of the simulated cointegrated series, and you can see the spread of it is nicely oscillating around the mean 0 because I have set the cointegration parameters to 0. All right, so now we know how cointegration works, and we have got plenty of simulated cointegrated data, and it is time to develop the mean reversion trading strategy on these cointegrated assets. So I will introduce the minimum profit optimization strategy. So a brief review of what we just discussed. So what exactly are we trading? When we're doing this pairs trading, we are actually trading the I0 series here because we already know how many assets we should trade and what is the ratio of the cointegration relationship. So we are actually trading this I0 series, which is mean reverting. So the natural question is where to initiate the trades. So we need to have an algorithm to help us decide the trade location. And this actually determines the minimum P&L per trade. And the second important factor is how frequent will our strategy be trading? Certainly, this is very important because if the trade is too frequent, then probably the profitability of the strategy will be eroded by the transaction cost. So here we have two factors to optimize. And in this setup, we actually set our optimization target as like the minimum profit per trade times the trade frequency. So we want to optimize the total profit within a certain time period. All right, so how does this actually affect the profit of the strategy? So if we set the location to be tighter, so we begin to fade extremes when the spread just travels a little bit far from the mean. This means we have tighter boundaries to start the trade. And this means we have a smaller minimum profit per trade, but we will have a higher trade frequency. If we set a looser boundary, we will have a larger minimum profit per trade and a lower trade frequency. So basically, we're trying to optimize a trade-off between these two factors and try to achieve best profit within a time period. All right, so first, it is we want to optimize the trade location. So the key question here is, what is the minimum profit per one trade? So assume the upper boundary is a U, a positive number, and we already know and derived the cointegrated relationship by doing a Johansen test or Engel-Granger test. So we actually have this I0 series already. So how do we trade this? So let's say when the spread cross over the upper boundary, we open a trade by fading the spread. So we're selling N of asset X and buying beta N of asset Y. However, when to close the trade? We will close the trade when the spread cross back over the mean. And we can similarly set a symmetric lower boundary for more trades. So let's see a visualized example. So let's say here we have a spread. We have like 50 days worth of like data. And we can see here we set the boundaries at 2. And there's like one place to initiate a trade. For example, when the spread cross over the 2 value and we fade it, and when the spread cross back to 0, and we just close the trade. We can similarly set up the other trade at the red line as well, like this. What is the minimum profit per trade? So we can just calculate the profit for each leg. So for example, let's say we want to calculate the trading profit for fading the overbought condition. So here is the short leg profit, and here's the long leg profit, or with a simple algebra, we can recombine these terms according to the cointegration relationship. And from here, we can see we can convert this profit in terms of the spread. And the great news is if we're only trading 1 unit of the spread, the minimum profit per trade is exactly the boundary value U. All right, so this is a very nice property. And here is like, it is noteworthy that here the minimum profit per trade is a terminal profit. So you might be holding this position for multiple days. And in the end, the minimum profit will be the boundary value U, but within the trade period, your mark-to-market profit might be very volatile, for example. So this is like something you need to take into consideration. And for trade frequency, we will use the concept of mean first passage time. So here, we assume the cointegrated spread between asset X and asset Y is a stationary AR1 process. So we will use the mean first passage time of the AR1 process to optimize the trade duration and the intertrade interval. The reason here to choose AR1 process is because we can actually numerically estimate the mean first passage time with ease. So the trade duration means the mean first passage time of epsilon t to the cointegrated spread to pass the mean if the starting point is at the upper boundary. And the intertrade interval is the mean first passage time of the cointegrated spread to pass the upper boundary if the starting point is at the mean. Usually we just zero the mean for easier calculation, but for real data, sometimes the mean is, it can be arbitrary, but you can always translate the mean to 0. I mean, this is like a simple linear transformation. It doesn't really affect anything. So let's turn back to this example. So what exactly is the trade duration? So here you can see the AR1 process starts at the boundary, and we want to know like what is the mean first passage time across the trade ending point 0. So here we only show one path of such possible, just one possible path, but the mean first passage time will be the average of multiple such process, and it can be calculated by this integral. And this is actually how long we will hold the trade. And for the intertrade interval, this is actually when the spread start with 0 and how long will it first across the upper boundary. So this is when we're waiting for, when we do not have a position, how long should we wait when we will start a new position? So this can be also numerically estimated by solving this integral equation below. I will refer you guys to the actual numerical algorithm to the actual paper in the end of the presentation. So here I will showcase like some results for minimum profit optimization. The paper actually used data that is dated to like 2006. So here we would like to see if the strategy still works like up to date. So here I have chosen a co-integrated pair from the S&P 500 constituents. Both of these are industrials. Both of these stocks belongs to the industrial sector, and my fellow apprentice Aaron will introduce how actually you can select these two pairs from all these constituents. But you can see during this in sample period, we have enough number of trades as shown here, and the P&L curve of the trading strategy shows a profit, which is nice. And what about the out of sample test of the trading strategy? Well, it also looks good. And you may notice it also covers the coronavirus market crisis. Of course, there's like a drawdown here, but in the end, it still shows a profit. All right, so this means you can actually design a minimum profit optimization mean reversion trading strategy on co-integrated asset pairs. All right, to sum up my presentation, so in this presentation, I actually introduced the definition of cointegration, which is a long-term equilibrium relationship between a pair of assets. And the cointegrated spread between the asset pair is stationary, providing the basis of a mean reversion trading strategy. And with ArbitrageLab, you can simulate cointegrated asset pairs, as well as optimize the minimum profit of the mean reversion trading strategy. Thank you. And here are some references. I will highly recommend the first one, which gives a very comprehensive introduction to the cointegration. And for the minimum profit optimization is the fourth paper. All right, this is like all my presentation. Thank you for your attention. I would like to accept any questions for now.